Hello everyone, welcome to Entering the Fall and our first panel focused on impact investing. My name is Bobbi Ivanova and I'm Managing Director and Investment Strategist at Simplify. So do a quick introduction of our panel. So starting Lauren Taylor to my left, who is the co-founder and Managing Director in Impactive Capital, which is a $3 billion activist investment management firm. So Mike Taylor, who happens to be our portfolio manager, also the Managing Director at Critical Mass Partners. Next to the left of Mike, we have Bhakti Mirchandani. She's adjunct professor at Columbia University, where she pioneered Impact Finance for Sustainability Practitioners course. And then further to the left, we have Emily Green. She's the head of private wealth of Ellevest, which is a women-first investing and financial planning platform with about $2 billion under management. So with that, we'd like to kick it off actually a little bit on a terminology side. I know there's a lot of terms out there: impact investing, environmental social governance, PRI, negative screening. It gets confusing. So we figure we clear some of the terminology first. And I actually asked ChatGPT, what is impact investing? So let me read you a quote, and then we can discuss if we're in line or not. So impact investing is an investment approach that seeks to generate both financial returns and positive social or environmental outcomes. It combines traditional investment principles with the goal of making a positive impact on society or the planet. So with that, I actually, since we have a professor on the stage, I'd like to turn it over to Bhakti, who can help us clarify some of that terminology and clear that for us.
Thank you, Bobbi. I am an adjunct professor at Columbia, but that's a hobby. My day job is that I'm the managing director of responsible investing at Trinity Church, Wall Street. Just wanted to share that in case anyone knows Trinity and thinks that I've quit my job or something horrible. All good. In terms of the different types of responsible investing, for us, sustainable investing means any type of investing that considers social or environmental issues. It's kind of broad. It's a component of sustainability broadly. Responsible investing is sustainable investing plus field building, capacity building, reaching out to different managers, sharing best practices. All of that turns sustainable investing into responsible investing. In terms of types of sustainable investing, there are a number of different types of sustainable investing. The most common is strategic engagement. And that's become much more common with the growth of passive and with passive managers wanting to do responsible investing or sustainable investing. They have to strategically engage with companies because that's the only tool they have. And then there are managers like Lauren who make an art out of it. And that's the investor corporate dialogue around sustainability. Also very prevalent is ESG integration, or systematically incorporating environmental, social, and governance factors into investment decision-making. Also very common is particularly in the EU, where all UCITS fall in this category, given some of the UCITS rules around cluster munitions and the like. Negative screening, which can be anything from excluding investments in particular sectors to divesting from them. Then slightly less common are things like positive screens or including companies or sectors for their social or environmental benefits. Sustainability themed investing in pursuit of a sustainable theme, but not necessarily measuring the impact. And the toughest one to do is impact investing, because it's deliberately seeking positive social and environmental change. It's measuring the change. It's even focusing on the impact of exits. It's measuring the negative impacts and the net impact. These are all very important and different components of the field with their own characteristics, but a common intention behind a lot of them.
Thanks, Bhakti. So actually, first question, I'm going to kick it off to Lauren, but after that, feel free to jump in as well. So how do you measure social and environment impact of your investments?
Sure. So at Impactive, we take a very pragmatic approach. We are interested always in returns. That is our main objective. And so when we look at a business, we're first asking ourselves, is this a high quality business? Is it run by a good management team? And then what can we do to engage with management and the board to further accelerate the business's ability to sort of compound returns? And oftentimes that's around capital allocation, but importantly on environmental or social initiatives, we say to ourselves, what is one or two interesting environmental or social or governance oriented initiative that one, solves a business problem, and two, can enhance returns because it makes the business more profitable or more valuable over time. And then we really just concentrate and focus on engaging with companies around those areas. So in terms of how we're measuring it, we're really measuring it to the extent it impacts the profitability of a company or the valuation of a company.
Got it. Thanks. Maybe second question, I'll go over to Emily. So how do you...
I had a follow-up question.
Yes, of course.
Sorry to jump in. You mentioned good management. How do you find out that they're good or bad?
Good question. We never bat 1,000 on this one, and we were huddling beforehand. I think what we have done, actually, we've modified our process over time. So we started in business in 2018, and we've modified it to the point where we used to put the engagement at the very sort of end of our process, meaning we'd sit down, we'd have a big PowerPoint presentation and say to a management team, we want to stand shoulder to shoulder alongside you, look out in the horizon and say, how can we make this company worth 2 to 3x over our time horizon, which is a 3 to 5 year investment period. We used to sort of tail end that type of engagement and back and forth to not scare them, because when they see activists, which we are, we file 13Ds, we go on boards, that we don't want to sort of get them nervous.
So sometimes you want bad management.
No.
So you can get rid of them.
Nope, never want bad management.
No, I meant
the worst thing.
If you're going to go activist, frequently, this is going to be turning around management.
I think but usually you have, so the way that we're different from most activists is we look for high quality businesses to start. They tend to attract high quality management teams, but as Buffett says, you want a good enough business because that a ham sandwich can run, because one day a ham sandwich can run it, and we've had those. But the way that we try to figure that out, and that's more of the art than the science of like modeling various different scenarios and coming up with an expected return. The way we do that is we come up with ideas early in our diligence process, and we do months of diligence because we're very concentrated. We have 10 names in our portfolio. We are then proposing ideas and just seeing how they respond to us. Are they taking it under advisement? Do they want follow-up? Do they ask us questions? Do they say, can we see your work? Oh, you've interviewed 100 of our customers. Can we talk about it? And in that engagement, you can get a little bit of an instinct, and then of course you do the interviews with people who have worked for them or with them, former board members, but that is harder, and there's a lot of I've gotten that wrong.
Sure.
Quite a bit.
I mean, we all get it wrong, yeah. Right? Yeah. Now, how many times? Because you're talking about all these management teams. Because I deal with a lot of bad management teams. I see them, and several of them. We get through most of my career in 20 years. I shorted half my book with shorts. Yeah. And I find lying management teams and frequently frauds, total frauds.
Yeah. The problem is you have to stay solvent long enough for the market to realize that, right?
Oh yeah. But often you learn to navigate that and figure that out. But have you ever gotten to the thing where you look at a company going through and then you find out in your due diligence is probably a fraud?
No, but I will say there are people, especially around, just to bring it back to the ESG topic, one of the examples that I was going to talk about is KBR. KBR was a triple for us. We invested late in 2020. And the interesting thing about KBR, if you look in the Wikipedia page, you'd say, how is an impact and ESG-oriented investor invested in this company? They had issues in Iran and Sudan. They were an energy E&C company, engineering and consulting and contracting company, where they would take risks to build like Exxon's, rigs and power and LNG facilities. And when the CEO came in 2015-16, he really tried to transform the business away from being an energy E&C business, which usually trades at like 6-7 times EBITDA, which is like a dying core, to more of a government services and a sustainable tech business. And he was so adamant about it, and we got involved 2020. So he had been doing this for 5 years, and he's, when we started engaging with him, we said, you need to tell your story better. We see you're doing this. One, you need to get out of the energy E&C business, because even if it's 10% of your business, you're over overall enterprise will trade at the lowest common denominator of risk, which is the energy E&C business. So he put a flag in the ground. He said, I'm getting out of that commoditized business. And then I said to him, okay, you also have to dial up. We think that we're going towards the hydrogen economy, but it's like way out of our lifetimes of investments, our 3 to 5 year period. However, a baby step there is going to be green ammonia, blue ammonia. And they have a 50% duopoly with this private company, Haldor Topsoe, on process designs for plants. And we said, you should be dialing up as much investment in both human capital and financial capital into the real sustainable business. They made an acquisition of a recycled plastics business that they can sell over their industrial complex. They got out of some of the more commoditized government services work. So over that 5 or 6 year period when we started investing, it had gone from a 70% energy E&C business to a 70% government services business. So they did everything from serving potatoes to folks in theater to like cybersecurity and space intelligence. And then the other 30% was this sustainable tech. 5% was the runoff of like the Exxon business, the energy E&C, which now they're completely out of. But the most important thing that we did was convince the management team, no one knows that you've transitioned. You think in your mind you've transitioned. So we restricted ourselves from trading. We worked with him and his entire management team to do an investor day where they can tell their story and demonstrate the investments they're making, linking it to their 3 to 5 year plan. And over that one day, the stock was up 25%, and the subsequent 2 days, the market's down. So like, oh my God, this like makes a ton of sense. And if we simply, for us, it did a lot in terms of when someone says they're going to do something, they are far more likely to do it. You'll hear, if you read Robert Cialdini, he'll Psychology of Influence, he'll definitely assert to that. However, more importantly, what I found just in terms of linking it back to your question is, they dialed up the sustainable tech business. They're now about to spin it out because they achieved their 2025 plan in 2023. But throughout that period of time, we were helping them with their sustainability report. And he was so ambitious, he wanted to say, we have reduced our carbon emissions by 90%. Now that's completely impossible. It was hogwash, right? We knew it wasn't. And he was getting cute because he wanted to get, he wanted to get all the MSCI ratings. He wanted to get the Sustainalytics ratings. When we invested, the stock was trading at 7 times EBITDA. When we exited, so we just exited, the stock was trading at almost 13 times EBITDA. So they got multiple expansion because of the tail end of the sustainable tech segment. But he was trying too hard. He thought he wanted. He was trying too hard to be what he thought people expected of him. And I said, just go with reality. Like, there's no way you reduce your scope 1 and 2 emissions by 90%. I don't know how this math is working. It was sort of hogwash. It's okay to have baby steps. Just own it and have a progression towards it. And I think it was refreshing to him to say, listen, I believe in what you're doing, but you don't have to be this hero. Just, be more like honest and authentic with like the progress you're making.
I don't know if anyone saw this, but it's starting to dim now, but there was an incredible glow coming off of you this whole time. Static electricity,
I like investing.
Nobody touched me.
Everyone else.
So she had incredible passion. That is really remarkable.
Thanks. Right. Well, thank you. Over to Emily now. So how do you balance that dual mandate of achieving both financial returns and social environmental impact?
Yeah, we struggle with this all the time. We deal with high and ultra high net worth investors, and part of our mandate is to move as much capital as possible to impact. And to do that, a lot of people, especially read the Wall Street Journal, read things, and they assume that you have to give up return. I think actually, especially in New York, where we think about philanthropy and we think about investing, and they're separate things. So when we're doing it, we do not give up return to do so. We very much state that to people. We're looking for market returns within there. I actually think you can even get impact alpha in some of these things in the way that you're thinking about it. And so when we're looking at it, and you can do this in all asset classes. So like in public equities, you can think about, we use the raw data actually from places like MSCI and Sustainalytics and such to actually look at the impact that every company is making. So not the ratings that like MSCI gives, but the data that they all get from these companies to be able to then make a judgment call on it. But when you're thinking about your returns, I can make a lot of arguments of the impact that you can make. But when we're thinking about, for example, product quality and safety. Well, at Ellevest, we always think about that because product quality and safety actually disproportionately affects women and people of color. So it's something that we're very focused on when we're thinking about our investing. As an investor, it also really matters for your bottom line returns. You think about Boeing. Guess what? If they had better product quality, if they had better safety when they were thinking about when they were those planes, their stock price wouldn't have tanked all those years ago with that. You would have actually foreseen some of these issues when you're actually looking at this. And so your bottom line is actually better off when you're looking at it. You look at things like, we do a lot of investing in private investments as well, so workforce housing. And people will say, oh, you know, workforce housing, the real estate market, all these things. If you find these people who have done it for a long time, and it's a really nice market because there's kind of always someone to live in these places. So, you know, you can look at it from an impact perspective and you say, well, great. You can look at these places that are getting sustainably renovated and have programs for the people who live there. And you're thinking about, you know, maybe they have programs with people coming from jail or from prisons and from these types of places and helping them out. At the same time, these investments tend to be really recession-proof within things. They've done very, very well. You don't want the people who started it last year because it was trendy, the people who've been doing it for decades and thinking about this. But like we have funds where you look at their pre-quin and they're, you know, ranked second out of their 85 funds. And these aren't just impact funds within there. And so when you're really thinking, I actually like to think about it as like full information investing. And if we're only thinking about financial data, you're only thinking about half the data that exists. And now all these other points exist that you can actually use as investors to make not only impactful decisions, but the right financial decisions as well. And so that we really need to look holistically across the data that exists.
Thank you. Over to you, Bhakti, on the next one. So how has the impact investing landscape evolved over the past decade in your experience?
I'd love to actually jump in on the last question because I have an asset owner perspective, which is quite different than the asset managers on this panel. When we underwrite our managers, we underwrite for portfolio sustainability, manager sustainability, and DEI. So that takes a different form where in only a very small handful of places are we interacting directly with the companies. By and large, we rely on our managers to do so. So we try to understand how rigorous they are in their approach to responsible investing, what tools they use, what risks they're aware of, how they price those risks, how they manage the risks and monitor those risks. We look at alignment between their values and our values as an organization. Although we are a church where racial and social justice and stewardship are all part of our core values, and we give away money every year in pursuit of those values, the goal of our investment portfolio is to maintain or increase purchasing power so that we can continue that work in perpetuity. With respect to managers, we try to understand how incentives work with our managers, how aligned our managers were with, you know, how aligned are their teams, how aligned are they with us, you know, what are their ethical standards, how do they respond to crises, and how do they think about DEI. So with some of these things, with sustainability can be overpriced. If everybody wants to make the same exact sustainable investing, it can be overpriced. So it's not kind of a silver bullet for anything. And sustainable investing can be done badly. So there are managers out there that just adjust a discount rate, and that's kind of a shortcut, and it's not a bad thing to do, but you could adjust cash flows and be very thoughtful and precise and meticulous, or it can be done badly. So we're aware of all of those things. We're also aware of the trade-offs between social and environmental. In some cases, those are aligned. There are 17 SDGs, which is a business plan for the whole world, and some of those are aligned, and some of those are at cross purposes. The research shows that companies that have environmental violations have a 23% increase in social violations in the following year when they pivot all of their attention to solving those environmental violations. So as a church focused more on social justice, we have to be mindful. We also care about the community and climate change. We are in Lower Manhattan. We will be beachfront property in 100 years. That is not good for our neighborhood or our community. We need to be balanced in terms of what we ask managers to do and what they ask companies to do. So it's a very tricky landscape, and one that we try to walk humbly with our managers as we're all coming up the learning curve together.
There's a current event that's happening right now that may have something to do with how you look at stocks and investing. And I watch it because, as you know, I watch everything that's going on in the world. I try to. We have a unique situation where the demand for certain goods, materials, energy, things like that, is sort of unwavering. But the social impact or political impact, if you will, of expanding that capacity to meet those energy and material needs is not there. And the US has been a great example of underinvestment in all this, and many other nations too. For instance, Europe basically pawned off their entire energy plan to a dictator in Russia. And now they're paying an incredible price for that. How do you deal with that strategically? And then investing-wise, strategically in that, do we think about the decisions that we're making, those sort of long-term implications? And then how do you deal with like what's happening today, where it would seem in my eyes you couldn't be for another steel mill or a coal mill or something like that, but it's very, very difficult to change the demand curve. So the prices go up, and then that hurts everybody terribly. And we're going through that right now. I'm sorry, that was like the hard question. I'll follow it up with something really easy.
Okay, I'll take a stab at that. That's a really good question. We have, our resources came from a land grant from Queen Anne in 1705, who took land from the people, and we try to use our resources for the benefit of the people in New York and kind of globally across the Anglican Communion. So we try to be very mindful of long-term. We try to keep the long-term horizon in mind. When we think about the energy transition, we care deeply about environmental issues. It matters to our congregation. We've not made a net zero commitment. Part of it is that we're not sure about the timing of the transition. We think about the timing of the transition from coal. Some of these things could take 70 years. I see the value of having an aspirational transition because people are working towards a goal. If you don't sign up for that race or know you have an exam, maybe you won't study. So I think there's huge value in making those types of commitments, and it's wonderful to see so many countries making those and organizations and working assiduously toward them. But what if the transition takes until 2055 or 2057? If we build a portfolio that is over-invested in companies that would benefit from a rapid transition and under-invested in companies that would be hurt by a rapid transition, then we haven't created a portfolio in line with our fiduciary duties. One thing that we have a lot of in our portfolio is investments in companies that green the use of fossil fuels. So even if we have the use of fossil fuels until 2040, let's say we make the deadlines and it's great, greening of the use of fossil fuels is still a good idea. It's still helpful. We also have some investments that are in climate change mitigation. Climate change adaptation is underinvested in across portfolios, including in ours, and we need to work on that. We have no investments in natural resources, but because we're a church and we have social justice is core to who we are. We have not made some of those climate commitments. I also didn't buy a new phone for 8 years after reading about cobalt supply chains, and I had to buy one eventually because it just stopped working, and then everyone in my life was begging me to buy a new phone. I went from the 6 to the 14, or the 5 to the 14. That's the jump that I made.
Wow.
Yeah, so it's really bad.
It's like, did you have to wind up the old one to use it?
It cracked when my daughter was born 5 years ago, and I used it for that many years. But and I just gave up like a month ago, and I had to buy a new phone. But it's just horrible the way these children are treated. The cobalt is mixed into supply chains. No one knows where it's from. 70% of the supply chains have child labor. It's horrendous. We care about human dignity. It's very hard to define those types of issues, but it is incredibly difficult. This is an incredibly difficult issue that we all need to work on together, and it's not straightforward.
So not a lot of Chinese products in your household. Okay.
The important role that Bhakti and Trinity play, though, is when you think about the transition is going to take many, many decades. We're not going to flip a switch and go all, hydro or solar. But we need institutions like government spending, like the IRA, like customer taste and preference. Consumers, across the board prefer sustainable products. But then Trinity and Bhakti play an important role to help lower the cost of capital for a lot of these initiatives, so that they can be more economically competitive. Otherwise, the cheapest form of energy, well, it's nuclear, but like coal, right? You'd have more and more coal, and we'd never make any advancements towards longer-term goals of reducing emissions and leaving our great-grandchildren a planet that they can inhabit in a healthy and prosperous manner.
Can I just jump in here too? And I think this is where private markets really help and innovation in private markets. and money needs to move. And a lot of these people, like we actually invested in a fund a few years ago that's focused on digitizing the construction industry. And so you think about climate change is going to cause an enormous amount of people to be displaced. We're going to need housing for these people. And so thinking about, and there's always side effects to things. And we always ask our managers all this, like 3D printing of housing, ways that you can build houses faster, all these different types of things. The problem is these were two women of color who started this fund. And money does not move to new things, or especially these women who have these funds fast enough. So we look at this and we see what they're doing and we're like, this is incredible. Like what you've done, what you've built, you have backgrounds in building, this is an amazing investment. You know, we look at all the impact. These two women, they only raised $18.5 million in their venture fund. And this was pre-SVB, times. If they were two white men, there would be people, jumping down their throats to invest in these types of things. And so we need to rethink about how we are investing and looking at this innovation and thinking about this is real change. These are things like renewable energy, these types of things. These are innovation. And yes, it could totally not work. These are venture types of investments. But in order to solve these problems, we can't keep the status quo. We have to be investing and thinking about the world's going to look like in 5-10 years.
Fortunately, it comes down to numbers most of the time. So if a compelling investment is there, it will be bought.
I disagree.
Okay, I take it back.
Switching on a brighter question now. So can you, each of you, share an example of a particular successful impact investing and factors that contributed to that? And Lauren, why not start with you since you're to my left?
Sure. Well, I spoke about KBR, which was very successful. I can talk about our largest position because I think it's often difficult to envision how improvement in diversity can drive economic return. And our largest investment is an auto dealer. When we started our investment, it was the 8th largest auto dealer. Today, it's the 3rd or 4th largest auto dealer in the U.S. And these are basically locally granted monopolies, right? Because they can sell the OEM car in a catchment area. But the real business, right? The bulk of the business, 75% of the profitability, or 70% today, is in parts and services, right? The aftermarket business. And as today, cars are more silicon than steel, right? Anytime you get a fender bender, you can't necessarily get it fixed at Joe's mom and pop collision center at the side of the road. You have to go to the auto dealer to get the customized, the LiDAR, the sensors, the cameras that are in the fender bender. And it's going to cost you more. It's going to take more time. Across the United States, the main issue or the challenge at both collision centers and also auto dealers that deal with these, repairs is a labor shortage, right? Their bays where they raise the cars up are utilized about 50% of the time, but it's not a hard capital issue. It's actually a human capital issue. And so we got curious about this, and when we peel back the onion, what we realize is this entire industry, looking at mechanics who were retiring faster than they can attract new talent to the space, they were overlooking one candidate pool, and that's women. Women represent less than 2% of mechanics, but they dominate the industry as customers, spending over $200 billion. So we got curious and we convinced the company that we own. We said, hey, listen, imagine you can take your utilization from 50% to 55% because the parts and services business, right? So that's like 10% growth. Because the parts and services business has a 26% EBITDA margin relative to a 5% EBITDA margin of the rest of your business, that drives huge incremental profitability and it has the highest multiple. So just taking utilization up by 10% drives 20, in that one segment, drives 20% to your overall enterprise value. So we convinced the CEO and the board to offer paid maternity leave. They're the first publicly listed company to offer paid maternity leave. They are going to a 4-day work week. They have 2 shifts to allow for things like childcare and elder care, which disproportionately fall on the shoulder of women. And we convinced them really with the economics of it. So where are we, right? We've been invested with them for just under 4 years. They've tripled their number of female mechanics, but that's going from like 20 to 60 on a base of a little over 2,000. And there's more work to do. I think they can get to 300. But we had to link the social initiative to business returns. And so here's one way, and the stock has performed very well, but they're still just making progress, chipping away. And I think in the next 5 years, they'll have 10% of like a 3,000 mechanic force as women.
So the way that we decided to do it in our impactful investing is to make the proceeds, the fees, the impact. And the profits, the net profits from the fees of our fund and my compensation goes to the Susan Komen Foundation for Cancer, breast cancer, that is. But I really view it as like all cancer, because any work that gets done on one cancer benefits all of them. And that was a way that I could have hopefully have a great impact. And if I could beat Fidelity and T. Rowe Price for a much lower fee and an incredible cause, I give the proposition to the investors of that they can do well and do good. And so far, so good. So I think we're coming up on year 2 next month. So,
Thank you. Bhakti, do you want to share an example?
Sure. Well, I mentioned that the vast majority of our portfolio is focused on generating returns that allow us to maintain or increase our purchasing power while being kind of in line with our values. We do have a $100 million carve-out for mission investing that focuses on racial justice, affordable housing, and mission real estate in New York City. There we have a diverse venture manager bucket, just given the paucity of people of color who invest, and the importance of the innovation economy in our country. We have a number of affordable housing investments, but what I'll share with you is a fund that is used, that a CDFI is raising, that focuses on preferred and growth equity. Before Silicon Valley Bank went belly up, it was a phenomenal resource for the innovation economy, in that new companies could get short-term financing without giving up ownership, and then they would be able to grow and scale their businesses that way. And this brought that ability to people of color, and it's something that we thought was very, very interesting. The financing was 3 to 5 years for growth stage businesses, and they had a return cap. So after they made a certain amount, they'll just redeem and give the business back to the people of color to grow and benefit their communities.
Thanks.
One of the things we've done, I think that we've talked to a lot of fund managers. We have a lot of fund managers on our platform. If someone has wrote impact in their deck, they have emailed me. And there are people, to Bhakti's point, who are real, and you have to kind of dig into what they're doing. And there's people who are definitely not, and they just threw it in their deck because someone told them they would sell. And there's one manager that we use that we came across probably 2 years ago now at this point, who they look to make an impact actually in East Africa and India. They only invest in impactful companies in these areas. For example, kind of like they're looking for the last mile in India. So for example, places that like Amazon car's not gonna go deliver something within there. They created basically an ecosystem for people to compile everything that they need every week. There's a woman who kind of like runs it in the community, and it acts like as an Amazon. But one of the things that I think this fund manager interestingly did that to me was so important within here was actually she gives part of her carry to each of the founders. And so when she's looking at it, she's like, how do I create the same ecosystem that we've seen in Silicon Valley where people are all investing in each other and doing these things? And she really put her money where her mouth was and says, I will take less carry for you to gain in this fund as well. And so every single portfolio company that she's invested in has that carry. They closed last November, so not even a year ago, and they already have a 1.7 times markup on their portfolio, so they've done very well. Obviously, there's unrealized returns, but this is real wealth creating, and these founders are people in these developing countries that really can create change.
Thank you. So let's flip it on the other side now. Let's talk about some of the key challenges that are faced by impact investor, and how could they overcome these? Emily, you can start if you like.
I mean, I think to even how we started, there's a lot of terms when it comes out. of just the things that you can do. Am I really doing it? I meet a lot of people, and they'll send us our portfolios, even endowments and like large endowments and foundations. They'll send us the RFP. It's all about impact. They send me their current portfolio. They say they're doing it. I'm like, you are definitely not doing it. All you're doing is negative screening in here. This is not, you're not making the impact that you think you're making. I think that actually one of the biggest, I'll reframe it as an opportunity that exists within this space is the fact that the people who control the money, so the financial advisors, the consultants of the world, are not educated on it. And it's a big problem because what happens is, and I promise you, we get people who write into our website, which I know sounds crazy to most people, but we have high and ultra high net worth investors who literally write into our site every day saying like, I want to fire my financial advisor. And then they write all these things, and I have someone on my team who talks to them. And one of the things that always comes up is I went to my advisor, I told them I wanted to invest sustainably, and they told me that I'm crazy. They told me I'm going to have to give up returns. They told me that I'm stupid, all these types of things. And so unless we educate, unless we take the time for the people who are then advising these individuals, families, foundations on what they're doing, it's going to be hard for these people to create change because they leave these meetings typically feeling like lesser than and that they don't know enough. So I think there's enormous opportunity, especially for some of these big institutions, to train people to do so, especially as we have the great wealth transfer over this next decade to women and millennials. But it needs to start happening now.
I'll speak about some of the things that give me hope and optimism and some things that concern me. In terms of hope and optimism, Trinity Church has always valued sustainability and inclusion, and there was always kind of an intuitive screening for managers for these types of characteristics. So when we started explicitly looking at the criteria and screening managers for, portfolio sustainability, manager sustainability, and DEI, we found that they were more sustainable and inclusive than we realized, and they were also more sustainable and inclusive than they realized. They thought they were just doing the right thing, doing good business, and some of them got quite excited that, hey, we didn't realize we're cutting edge in this new field. This is pretty cool, and that made them more, committed and excited about that. So we saw we kind of thought about it as kind of like the value investing equivalent of sustainable investing, that they were more sustainable and inclusive than they realized, and just given the right tools and language, they could do much more. So we saw that a lot in our portfolio. Most of our managers have been on a sustainability and inclusion inflection point where they're rapidly making changes and progress. So all of that gives me hope. In the wider industry, there's been some confusion on terms. Some people kind of not having clear definitions. The regulators are addressing a number of those things. And then also self-regulatory bodies have started to address some of those things. Having universal adoption of TCFD across geographies, SASB becoming the standard that TCFD adopts, the ISSB, IFRS setting up a set of sustainability standards. Now the sustainability and climate standards are out. They're working on the other standards. That will all be extremely helpful once everyone understands what the parameters are, and there's their global standards. There are a lot of issues with some of these things, like Scope 3 emissions, but as they become required, the technologies will develop over time. So by the time they become mandatory, I feel like we'll be in a good spot to actually address those issues. There have also been studies that show that it costs a lot more for investors to figure these things out on their own than it takes for companies to disclose them. Within our country, there's a lot of pushback on disclosure, on strategic engagement. During the Trump administration, there were a number of agency actions that limited some investors' ability to incorporate environmental social governance and investment analysis, and limiting strategic engagement. It can be done well, it can be done badly, but there were 18 anti-ESG bills before Congress this summer. There were a number of ESG hearings that happened as well. And now the left is talking about freedom to invest and freedom to get information, to make investment decisions, and to engage on issues that investors find material. And then the right is talking more about protecting the fossil fuel industry. And there's just, both sides, and I actually went to some of these hearings. I had to speak at an ESG roundtable in the House of Representatives, and I had to sit through the hearings so that I could say things that were relevant to the hearings. And the structure where everybody gets 5 minutes to make a statement as well as ask and hear answers to their questions is not productive, because there's a lot of nuance. A lot of statements are, okay, you're 60% wrong and 40% right, or the opposite. And I think a lot of the truth lies in between. So those things give me concern. I see in Europe that there's a big movement on the environmental side, and just given the size of European markets, I think there will continue to be progress. In terms of DEI, given the recent affirmative action case that happened in the Supreme Court, and a lot of anti-DEI lawsuits will make it harder. There's some progress, like if, for example, in the investment management industry, 1.4% of assets are managed by minority and women-owned firms, which are 69% of the population. So if 69% of the population manages 1.4% of assets, then I think we can say that there's structural problems. So to make progress on some of these issues, there has to be kind of different, to continue some of the momentum, but with a much more careful and circumspect approach. But then there will also be some stumbling and some reversals.
Thank you.
Getting it right in the respective allocation of these sort of funds, ideas, your energy, it's so difficult because it's going to be imperfect. And I'm at a point in my life now that I understand that imperfection. I understand that every dollar isn't going to go exactly to where I would want it to go. I also understand that where I would want it to go is probably wrong or imperfect. Let's say imperfect. My wife will say wrong. But I have to deal with that. So knowing that, so my goal is to make the numbers so large that the impact is so meaningful that I won't get terribly upset about the things that were incorrect. So we live with it. You talk to Mike Taylor at 35, different story. Mike Taylor at 36,
Great.
totally different.
I would say it's patience and time is the biggest challenge to sort of achieving the impact and sustainability and ESG change. First of all, just if your financial advisor is calling you stupid, he should or she should be fired. So just put that aside. I wanted to respond to that. But I think it's patience and time, because naturally the type of investing we do is we only have 10 companies. We're deeply engaged with the management team and board. And when I come to the table and we say, hey, you should be spinning out this segment, or you should be making this acquisition, or buy back stock now because no acquisition is affordable, just given money was free. That was the past couple of years. That can have an immediate impact on valuation. When we are engaging around a social or a governance-oriented, we're changing executive compensation across the board to be more shareholder aligned, or an environmental goal, right? You should be investing in more sustainability products to sell to your industrial complex. These are things that don't happen overnight. They're not a light switch. They take time. And so you just want to make sure that you have, and we at Impactive, we have the luxury of long-term capital. It's almost the impact-oriented work that we do, it has almost a snowballing effect, but you have to have the wherewithal and the time horizon to be able to see those returns really compound, which take longer.
Great, thank you. So we only have time for one more question, and I want each of you, if you can share your thoughts on how do you see the future of impact investing, and what trends should we be paying attention to?
If you want to start off, sure.
Yeah.
So I think impact and sustainability, everything's being very politicized today. So I think the pendulum is swinging, anti right now. And I think it'll settle down to a point where we realize we're not going to abandon these things that are just, simply good for the world and frankly good for business. And so I'm extremely hopeful and optimistic. I think the business community will come to appreciate that there are specific environmental and social and governance-oriented goals that will make them stronger, more competitive, more profitable over the long run. And then when you get those companies and those managements who see that these things are actually strengthening the business, I believe it's going to be the best in their industry segment that figure that out first. once you have someone who's more profitable than you, there will be pressure on other companies to follow suit. So over the long run, I just think, we have an opportunity to change industries and to change corporate America, and I think that's where we're headed. I think there's a near-term abandonment and politicization, but in the long run, the directional arrows of progress point upward, and we're headed there.
I actually think the future is extremely bright. Because one thing that's changed an awful lot over the past 15 years is transparency. And of course we could argue that we see so many bad things that are happening, bad actors that are everywhere all the time. The point is that we know about them now. And I think that's what's changed, is that there's actually been many bad actors throughout recent history that were simply unknown and not known to the correct degree. And I think the transparency of the internet, okay, it's TikTok, and and it has changed the focal lens, and that we can see what is happening. And so impact investing has been birthed to change that and to cast a critical eye on what are we doing. And if we can do that, and I know we can do this with results that are competitive, wow, the future is bright.
But Mike, do you have a TikTok shimmy that you can show the audience to prove that you actually...
Well, I've recently lost 20 pounds.
On TikTok? So. That's great.
But I'll save you the shimmy.
Okay, all right.
I'll need some instruction, though, off stage in the green room. Okay. That doesn't mean Mike Green is invited.
I'm also optimistic about the future of impact investing. If we look at the past 10 years ago, there were 600 ESG frameworks. There were 400 environmental frameworks, which is why Mark Carney asked for the development of TCFD, Task Force for Climate-Related Financial Disclosure. Now there's one framework that's used in the vast majority of the world. Most investors are using SASB standards to look at financial materiality across industries. And now that the sustainability standards have converged, it's time also for impact standards to converge. There was some debate while the sustainability standards were converging whether impact should be rolled in, but then it was already a lot to bite off. Most impact investors now use the operating principles for impact management, which is a minimum set of standards of 9 things that need to happen to call something impact investing. But there are a lot of other models that are out there, like, for example, impact-weighted accounts. They're ways to measure the value of how products and services are created, how employees are treated, and there's a big project around that. So all of these things can converge. There's one universal set of impact ways to measure impact, and that'll be really helpful in terms of having the discipline across the industry that's needed. During the Great Depression, we didn't have accounting standards, and we've come so far. So with all of these different areas that are equally important, we'll also make progress, and there are a lot of smart people working on these issues.
I agree. I think there's a lot of optimism to be had. Yes, there's a backlash, but I do think there's positives in any time there is a backlash. And one of the things is I think that people who work in the impact ESG space, whatever we want to call it, have actually been talking more together, which didn't happen for a long time. I think people are like kind of in their silos, and if you were an OG impact person, you kind of had a group. If you were newer, you kind of had a group. And I think there's just much more conversation being had. I also think when things are divided or politicized, it actually makes people, you don't need 100% of people to agree with something for it to work. You don't. And I always say that at Ellevest, and people are always like, but you focus on women, what about men? And I'm like, well, we don't need the other 50% of America for us to be profitable. You know, it's fine. And I think that as we look at what's happening, it actually creates more conversation. People wondering, what is this actually that I'm reading about? What can I be doing? And I think that'll only continue to happen as we have, as I mentioned, there's an enormous wealth transfer that's happening. And as we look to what's the next generation of wealth, it is majority women, millennials, Gen X. And if you look at the research out there, these are groups who have asked and demanded, whether it be sustainable, ESG, impact-based investing. And so these are people who are thinking about it. It's not going to happen tomorrow, but I do believe we'll see some progress over the next decade.
Amazing, thank you. So just to summarize quickly, thank you all for your input. We heard a lot about challenges, misconception, a lot of different terminology, but ultimately, I think the bottom line of the entire conversation was that we don't have to sacrifice returns in order to make an impact. So I appreciate you clearing this up for us. And ultimately, again, future is bright, as all of you have said that, and we all have a part to play with that. I really appreciate you coming today. Thank you.